if you can hear me, Feroze, what's going to be your risk profiling and what kind of a risk appetite do you have, Feroze?
Kavita, see, I think, like you rightly said, risk, and Ajit Saab also said, risk and chance are different. I think that's a very, very valid point. I personally think risks are of different kind. I personally respect or only worry about those risks which are permanent write-off to capital or permanent reduction in capital. Now, what are these kind of risks? Now, if I look at credit risk, it can mean permanent write-off of capital. For example, if I've loaned my money to some company and the company goes bankrupt and does not have enough assets to liquidate and pay back all the people who deserve to be paid back, that's money gone for good. That's permanent risk to capital. Those are very, very sensitive risks for me as a person. Second, I personally think any risk which is price risk, which is of an asset which has an intrinsic value temporarily on a piece of paper which is called portfolio, if it shows lower, it doesn't bother me as much because the risk disappears and corrects itself like a wound. The risk can either be like cancer, which magnifies with time. It could also be like a wound, which heals with time. So market risk or price risk, especially in equity, because there are so many people going to work. Now, if I buy a large company, there will be lakhs of people going to work and creating value day in and out. And that will, over a period of time, make sure that the businesses do well in most cases, not all cases. So that's why I think risk has to be categorized as permanent loss to capital or temporary loss to capital or return. The temporary ones are very intimidating, but they don't need to be so as intimidating as it is for most common people.
Right. But Feroze, can we do without taking risk? Is that right that, we just do not take any risk in our portfolio and still expect good amount of return or earning on the kind of investments we've got done across asset classes?
Kavita, you're so right. See, there is no gain without a pain, right? You want long-term great inflation beating wealth creation, right? And you don't even want to have a little disturbed sleep once in a year. See, so basically, you can't expect the moon from the world. And then I think there is something wrong with the human expectation that I should reserve 3 times more than an FD. And it should not even fall 10% in the interim, momentarily. Now, that's an unfair expectation. If that's the expectation you have with money, I dread to imagine what's your expectation from your spouse, right? So point I'm trying to make is you have to have fair expectations, be it an asset or a human being whom you're expecting something from. So that's point one. Point two, I think what can you expect? I think if you're speaking of equity, which is supposed to be risky, which it is in the short term, it falls 10% every 8 months on an average for the last 24 years. Every 8 months, you will see a 10% correction from peak to trough. So if you are not used to this, then you don't deserve 3 times more than a FD post-tax.
What kind of risk understanding do they have? Because we know that young India or young investors are flowing towards risky assets. You talk about FNOs, you talk about crypto and other asset classes. At the same time, they are slightly passive or not so exciting attitude towards mutual funds. Share markets, yes, obviously we've seen the equity participation numbers. Even the SIP numbers, in fact, have been reaching a new high every month. But what's the change in terms of risk mindset, if I have to ask this, especially connected with young India or young investing India?
Yes, Kavita. I firstly concur again with what Ajit Saab said, that it is not about, it's about how much amount you're going to invest. If you're going to invest a substantive portion of your wealth, you better understand it, deep dive, and then figure out each element of the asset or a specific commodity you're bringing into your portfolio. And risk doesn't come with what you do. Risk is actually defined by how much you do of what you do, right? If I put one third of my money in a specific asset or a specific share or a specific business as a startup promoter, then that's substantive portion. So coming back to your pointed question of what do you see as a trend, I think the good part of the trend which we identified is that people who are gambling or speculating, what do I mean by speculating, is not understanding the asset or the instrument. Now, for example, if a person is dabbling in derivatives, which is something which I have understood a lot more than crypto, pardon my ignorance, my knowledge on crypto is significantly lower. But on derivatives, what is clearly coming out is that speculators largely don't understand even option Greeks. What is delta, gamma, vega, theta, rho, vera, and veta? If you don't know these seven, people have not heard these, and they're dabbling in derivatives. So it is speculation if you don't know these elements. But most people who are speculating with not more than 2, 3, 4% of their wealth, which is quite an easy feeling for me when I speak to them. They're doing 30, 40, 50% of their savings into something which is more tangible, more stable, be it real estate, gold, or equity mutual funds in the form of SIPs. And only about 5, 7% is what the same person is dabbling with. And I hope that proportions don't change in the long term. And that adrenaline is good if it is 4, 5% of one's net worth.
Thank you so much, Feroze and Ajit, for taking time out for this particular hand-holding, that you did for our investors, and especially our young investors. Thank you so much.